Yeah, there we go. All right. It's wonderful to have you all with us this morning. Today is a special Sunday. As I think you know, we have Brother Mark McGruder with us. He's going to be teaching the Sunday Morning Bible Fellowship, and he's also going to be making a presentation during the morning service. This is all about stewardship. This is all about using the gifts that God has given you. Can you guys turn me up a little bit more? This is all about stewardship. This is all about giving the gifts that God has given you back. Ways that you can serve the Lord in the ways that He's blessed you. Thinking about that at the end of the year, thinking about that as we launch into a building program. And there's more that we're going to say about that during the main service. But without further ado, I want to hand it over to Brother Mark.
Thanks, Scott. I appreciate it. Good morning, folks. I don't know if you guys remember me from 2017. We were here. We were teaching from a book that looks something like this, the Stewardship. We had a 3-day stewardship seminar here. And it's about 60 pages long. I'm not doing that today. I am doing, in the book it says avoiding costly and dangerous mistakes in retirement, and then this just says the costly and dangerous mistakes. And my son's here today to help me, and he'll hand these out. This is what we're going to concentrate on today. We don't have PowerPoint presentation. It's kind of old school, and I did say costly and dangerous mistakes in retirement, but it's really 80% of it can be used by anybody. You can use these tips and techniques to save taxes, to give more generously, to plan for giving to your church in tax-effective ways, or saving capital gains and things like that. But while Paul's handing them out, let me open in prayer and ask the Lord for guidance today as we are lifting Him up and worshiping Him in all things. So, Lord God, we thank You for this day that You have made. Let us rejoice and be glad in it. We ask for wisdom and discernment today, Lord, in all areas of personal finances, taxes, investing. It's all Yours, Lord. We're just called to be the stewards, better stewards of what You've blessed us with, Lord. Would You give us all the wisdom and direction in that area so that we can bring You all the honor and glory. In Jesus' name we pray. Amen. So within that book, if you remember, there's 3 days worth of education there. This is kind of our syllabus. I'm taking 2 pages out of it for today. And then Paul's going to actually hand out a tax return as well. Now, don't get alarmed by the tax return. I'm not going to do taxes today, but you can take notes on these tax returns and circle it and highlight it, and I'm going to bring up specific lines. And you can go look at your own tax return, and if you're paying tax on your RMD, required minimum distribution, if you're over age 72 now, there are ways to avoid that, and I can show you how to do that. So you can avoid some taxes on your RMDs. The other housekeeping item is, and I'm not handing every one of these out because it's about our company. If you want to make an appointment with me or call me, I do have an office here in Chandler now. It's about a half an hour away, but it's right off the 101 and Ray Road. So it's kind of easy to get to, about a half an hour from this church. And if you want to make an appointment to see me, I'm here through Saturday. You want to come in and show me your tax return, I can talk to you about that. I can't do that in a setting like this because there's just just too much personal information there. But I'll talk in generalities, and if you have a general question, you can stop me and answer those questions. And I'll be done here by 10:15 today, okay? So if you want any of the brochures about our company and our background, they're on the table back there. And I will probably have business cards. I forgot to leave my business cards back there, but our phone number's on here as well. You can call that. Paul will actually make appointments today after church, not after Sunday school. Well, we might have time at 10:15. But if you actually want to see me, he's got our calendar with us, and he'll make an appointment. We can meet for a half an hour, 45 minutes in my office in Chandler, and just try to find ways to save you guys taxes. I'm an enrolled agent, which is a person licensed by the IRS to practice and represent people before the IRS. So I've got a lot of education in taxes. I'm also licensed by FINRA, which is a securities, who regulates our securities industry in this country. And I'm also licensed by Arizona State for life, health, and accident insurance. So I'm licensed in insurance and taxes and investments. I'm just not a licensed attorney. So I have no way to give legal counsel or to do wills or powers of attorney or healthcare directives, but we work with a couple Christian attorneys here in the Valley as well if you need help in that area. I can recognize where if you don't have a will, power of attorney, or healthcare directive that you need to get one done. So without further ado, does everybody have the costly and let me do one more housekeeping thing. Because I'm licensed by FINRA and IRS, and I have to get all this continuing education, anytime I speak or give an education class on it, I at least need your name on the sign-up sheet. There's a place for an email, place for a phone number. If you want to get our podcast, we have a Stewardology podcast, or if you'd like to get financial articles, we send those out once a week too. You can check those boxes. So, but at least put your name on here that I know that you were here. I would appreciate that. I need no other contact information unless you want me to contact you. So sorry I have to do that, but that's their regulations. So, and by the way, if you don't do anything on it, I'm not going to come after you. So I appreciate it. Thank you. Just kind of pass that around. All right, all the housekeeping stuff is in order. So do you have these costly and dangerous mistakes to avoid in retirement? Does everybody have one of those now? You can have one per family, kind of share, lean over. I can cover all of these in about a half an hour, but it's not going to leave me much time to go through specifically how am I going to help you save taxes, because there's great ways that people can give to the church. You're giving to the church already. I'm going to tell you tax-effective ways to do it. So I don't want to cover every line item on here. There's 16 different items. If somebody has questions on any one of these things specifically, you can ask me. But some of the highlights are estate planning mistakes to avoid. And this is true. Again, I said 80% of this can be used for younger people as well. If you're 30 years old and you have 2 children, you're not really thinking about your estate plan, are you? You're probably thinking of, how do I pay the bills and who takes care of these kids if I die, right? So that's really part of your estate plan. Remember, your kids are always going to be your most valuable asset no matter how much the Lord blesses you with, right? They need to be taken care of. So you need to have guardians for your children. And I say if you're on a rare date at 30 years old and you're in a car accident, and I have one client like this, both parents were lost when she was about 7, she's now 20. Who is the guardian of those children? That's the most important thing. So make sure you have your legal documents in order. And if you're a single person, whether you're single by death or single by choice, you need to have somebody that can handle your estate if something happens to you. You're injured, you're in an accident, you have COVID, you're in the hospital, your bills still need to get paid. So you should have a person who's your power of attorney. Power of attorneys are only good while you're still alive. They can't do anything once you pass away. Then it goes to your executor. I told you I'm not licensed for this, but I at least know the direction to give you on it. So when people say I'm going to worry about my estate plan or worry about my legal documents later, I would say that's a mistake to avoid either in retirement or whether you're not retired yet. Just have some type of estate plan together. And we use a Christian estate plan. What's a Christian estate plan? I don't know if you know this, but your will becomes a public record, and somebody can look this up 100 years from now. 100 years from now, you may have great-grandchildren that want to know about you and look up your will. You can put your testimony to faith, how you came to know Jesus Christ. You can put that right in your will. And your attorney has to do that because it's your will. It's your desire what you want to put in there. So I see a lot of things like, I know I have some wealth and I want it to be handled and God be honored in all of this. I want, if I have 3 kids like I do, if you have 3 kids like I do, I want 1/4 to go to the Lord's work, 1/4 to each of my 3 kids, and that's how I'm going to split up my estate. And I want them to know that up front, and I want them to know that on paper, that I'm honoring the Lord in this. And some of my boys aren't saved. Paul, my son, is a believer. He understands generous giving, but my other kids may not. But they're going to know my faith and my will and my testimony, okay? So not keeping it up to date. I don't know if you know this, but the Hipaa laws changed about 10, 12 years ago, and some people have wills that are 20 years old. So the Hipaa laws, it's the Health Information Portability and Accountability Act. It basically means even though you're married for 50 years, you don't have a right to each other's medical records. You know that when you go to the doctor. You don't have a right to each other's financial records either. Even though the I in IRA means individual retirement account, I treat it as your joint money. Actually, I treat it as God's money first, and then I treat it as your joint money second. So, but you still have to write something down that you give permission for your spouse, even of 50 years, that they're allowed to have access to your medical records, to your financial records, and that they have
powers of attorney. If you don't have a joint account, I have one bank account that's just my own account for business, but it's a TOD, transfer on death, to my wife. If I die, she gets it all, but I don't want her using that for our house accounts. I want to use that for my business expenses, and she'll have access to it if I pass away. So that's another thing too, is not titling your assets properly in number 4. If you have everything in your individual name and you pass away, it's got to go through a probate process. Now, probate sounds like a nasty thing. It really just means to prove in the court of law that I'm the rightful owner of this property when that person passes away. You can take care of it all before that person passes away just by having it in your will. But if you have to go to court and prove that this bank account with only my name on it is now my wife, she has to show her marriage certificate, and she has to prove that she's been married to me, show the driver's license, the same address, that sort of thing. It gets a little sloppy. Yes, do you have a question? Yep. So I do that for my older clients. They don't want their kids having access to their money, but I do it as a TOD, transfer on death, or in trust for ITF on a bank account. Yeah, depends what you want them to have access to. Now, if you're 80 years old and you're having trouble reconciling your bank statement and you want them to be a joint owner, you can title your assets as joint. When you pass away, it's their ownership as if they were married. It goes to their, yes.
You keep using the term will. I'm assuming you include trusts in there.
Yeah, a trust usually has a pour over will. Again, I'm not an attorney, but a trust is an entity that never dies. Think of it like a corporation. The CEO can die and a new trustee takes over. It's a different titling of the assets. If you have a very complicated estate or you have assets outside of your home state, like I have property here in Arizona and property in Pennsylvania, a trust is the best place to hold those assets because the trust won't die. When the trust stops serving its useful purposes, though, it can be dissolved. And I'm dissolving some trusts now that both parties, a couple are dead, and they have 6 heirs, and they want to just distribute the assets to the beneficiaries of that. But you usually have a pour over will as part of a trust in case you forget to title something in the name of the trust.
We have both of those.
Good, great. Yeah, you'd be a good person for people in the church to come see and talk to about estate planning. So that leads us to number 5, buying a trust you may not need. There's lots of attorneys that'll sell you a $5,000, $6,000 trust, title everything in that, and you really didn't need it. You have your house. And by the way, Arizona is a very friendly state to own property in because they have beneficiary deeds. They don't have that in every state. So you can put a beneficiary on your deed and avoid probate that way as well. So don't buy a trust if you don't need one. But if you have a complicated estate or a high net worth or lots of beneficiaries or lots of assets in lots of different places, then a trust may make it simpler because the trust is an entity that doesn't die.
Another question. If you have everything in the trust, does that eliminate taxes?
No, taxes pass through, and it does. The only thing it really eliminates is the probate cost.
It doesn't eliminate taxes on inheritance?
No. Pennsylvania's got a 4.5% inheritance tax, and that's on every dollar, whether you own it or the trust owns it. Yeah, good question though. And then the other thing the trust won't avoid is Medicare. Some people want to put it in a trust for Medicare. There's always a 5-year look back, and I would defer to an attorney on that because there are ways to protect your estate from having to be dwindled down to be used for Medicare or long-term care, whereas Medicare does not cover long-term care. We have insurance to cover that. So if you have a high enough estate that you don't want to be dwindled down because of long-term care, you should look into a trust maybe for that too, to protect a little bit of that. Okay? Any other questions about estate planning? Sure. Well, you hear stories of it and it happens and it's not legal. Can they spend it? Yes, because they have access to it. So the power of attorney, you want to be somebody you know and you trust. A power of attorney is supposed to be acting in your best interest. So if I give power of attorney to my children and they're taking money from my account and using it to buy a vacation, then I can take them to court. Even in families, you have that problem sometimes. But can they have access to it? That's what you're giving them access to if you're giving them power of attorney. Now, a bank is supposed to say, why are you signing this check? And you're supposed to say, well, here's my power of attorney. The person's in the hospital. I'm paying their electric bills. That all seems reasonable, right? So, but there's always problems. Yeah, that's what we're all sinners in need of a savior, right? So, yeah, good question though. But they do have access to it. So you want to put it somebody you know in your trust. Now, if you want to keep your power of attorney, the piece of paper, separate from that person, I've heard suggestions of that as well. Whereas that person knows where it is. It's in an unlocked, fireproof box in my house. And if you need that power of attorney, come to the house and get it. If they're going to come to the house and you're able, you're going to say, no, you can't have it today. They can come to your house when you're in the hospital and they need to prove the power of attorney. You don't want to put your power of attorney in a safe deposit box in the bank because that person's never going to have access to it. So there are some controls for that, but it really should be somebody you know and you trust implicitly, right? So, okay. Other thing, number 6, is not talking to your spouse or kids about money, legal documents. You'd be surprised when people die, their kids have no idea where it is, what to do. When I do a net worth calculation for people, I have that whole list. So when somebody comes to me that is the executor of the estate or has power of attorney because somebody's in the hospital, I say, have you asked about the gold coins in the bedroom? Oh, we didn't even know they had them. Or have you asked about an old 401k that's sitting in an investment? Maybe I don't manage it, but I write it down so I know what your assets are. Know the conditions of your flocks and herds, we're told in Proverbs. Anybody own flocks or herds here? Are you exempt then? No, because their flocks and herds were used for retirement. That was their livelihood. That's how they paid for things. So we are to know the condition of our 401k and our IRAs and our investments and that sort of thing. Okay, know the conditions of your flocks and herds. Avoid being a pack rat. Number 7, you don't need everything. Ask yourself when you're saying, do I need to save this, can it be reproduced? 99% of the time it can. I still have my first tax return I filed when I was 16 years old. But it's okay, it's a nostalgia thing. It's handwritten, it's $3,000, I worked the whole summer, it's still written in pencil. I do that because I keep one page. I don't keep all the supporting documents for it. I just found that and I just said, that's a neat little tax return, I'll keep that one. But I don't keep 3 years ago tax return or information, or it's all scanned, and I don't want to keep a big pile of stuff around the house. I'm very big on getting rid of stuff. And most things can be reproduced. So if people come to me with their old statements and their old tax returns, I say, can it be reproduced? And everything can. Then you can get rid of it. If they want to keep it or write it down, they can do it that as well. Okay? Don't be a pack rat. All right, so that's the area of estate planning mistakes to avoid, and you can do that with any age, not just in retirement, okay? So let's talk about these financial mistakes to avoid. Not having a long-term perspective even as a retiree. If you retire at age 65, 67, or even 70, what's the likelihood as a married couple one of you will reach age 90? Anybody know the stats on that? It's over 50% of a married couple that reaches age 65 will reach 90. So that's a 25-year plan. Is that long-term or short-term? Pretty long term. Even if you're 20, 25 years is a long way away. If you're 65, 25 years is a long time away. It's 90 years old, but it's pretty common. So remember to keep things in a long-term perspective. I have to put some people in, like 50% stock and 50% bonds, even in their 70s, because they need some growth. If you have a large enough estate and you don't want your money to go away in a bad stock market, then we can actually put more in bonds or take less risk because you just don't want to lose that principal. But a lot of my 70-year-olds are 50% stock and 50% bonds because I have a 20, 25-year plan for them. Now, if you have cancer and you're a surviving spouse and you're 75 years old, then we can look at more of a short-term plan. But I try to look at a long-term perspective even if people are in their 70s. Would you agree? The other thing to avoid in financial mistakes is trying to time the market. I can tell you only 2 things. The market will go up and the market will go down. Nobody knows when. If somebody knows when, they're lying to you. And if they think they know, they're just making money. Try to follow what they're doing. I tell people 1 out of 4 years will be negative, and we plan for that. if you have 3 positive years in a row, it doesn't mean the next year is going to be negative. The law of averages are it is, but you could have 6, 7 years in a row of positive. You just don't know when the negative year will be, although you do know there will be a negative year. Don't try to time the market and say, hey, the market's up this year, it's going to be down next year. In fact, speculation is if in an election year, the market's usually up. So I suspect next year, even though we've had 3 positive years in a row, I suspect next year will be positive because the government keeps pouring money back into the economy. Right? Eventually that'll stop and we'll have higher inflation. I mean, inflation is pretty high now, but there will be a negative time. And that's not a time to panic and pull out of the market. You want to just redeploy your income. When I rotate into different sectors when the market's down, I'm usually into consumer staples. That's things like soap and shampoo. It's pretty recession-proof. Procter & Gamble soap and shampoo, or Campbell's soup, those sort of things. Or I rotate into real estate. It's very good when the market's down normally because people still need to buy and own homes and rent homes, or real estate commercial property is good. Even in those times, that's pretty inflation resistant. And that's why it's nice to talk to somebody about these things on a regular basis. Don't succumb to slick sales pitches and buying investments that you don't need. Most people, all you need is a simple investment. A mutual fund is, think of a mutual fund like a coffee cup. The mutual fund is the coffee cup. Inside are pens and pencils. That's the stocks and bonds. Something simple like a mutual fund is easy to explain, but derivatives and writing covered calls and inverse ETFs, they're all pretty confusing. If I can't explain it to my mom, I don't want my clients to be in it. Does that make sense? If you don't understand it, you should tell somebody, I don't understand it, I don't want to be in that investment. So 99% of what I do is mutual funds, which are a blend of stocks and bonds held in a coffee cup by different companies like Vanguard or Fidelity or Schwab. Any questions on investments you don't need? I'd say the same thing about annuities. Annuities have a purpose. If you're very afraid of the market, they will guarantee you an income stream for the rest of your life, but it's usually a fixed amount and it's usually around a 3% guarantee. As an insurance company, I know the market average is 7-8%. If I can give you a guarantee of 3, where do you think I'm putting the money as an insurance company to make more than the 3% I'm giving you? Now, they look like heroes when the market's down to 15% and you're at 3% positive. That looks like a very good year. But they know the next year they're going to be up 15 and you're still getting 3. I'm not saying annuities are horrible or wrong or bad. Just consider it. Do you really need that guarantee? If somebody's calling me every week with the market's ups and the market's down, I'm going to suggest an annuity because I want them to stop bugging me. Because I can't control the markets up and down. I know over time it'll be up and it'll be down. If you're that afraid, maybe 25 or 40% of your investments should be in annuities. But remember, once you fix in your $1,000 a month, 10, 20 years from now, you're still getting $1,000 a month. It's not going to change. You have to have a plan for inflation. And I like to remind people, don't die with an annuity. There's a potential tax disaster there. If you have an annuity that hasn't been annuitized yet, the person who inherits has to pay ordinary income tax on anything above what you haven't, anything that's grown, and that's ordinary income tax. It's not capital gain. So that's why we say avoid dying with an annuity. Again, if you install an annuity at 65 years old, but you implement it at 75 years old, that's a decent plan because you're going to get that $1,000 a month for the rest of your life. You can even make it $1,000 a month for the rest of both of your lives. But remember, that amount doesn't go up, and if you die with it, there's still gains there for your heirs to get that. So that's why we usually do a dual annuity. And a lot of times when annuity's been annuitized over 20 years, there's nothing left for your heirs. That's another disadvantage of an annuity. Okay? So also a financial mistake to avoid is not getting help when you need it. Again, this can be done for a 25-year-old or 50-year-old or 70-year-old. If you realize you need help in something, does everybody have one of these? Right? This is my favorite tool in the toolbox. It seems like I do this 10 times and somebody shows up and puts new windows in for me. Have you done this? Have you seen this thing? Or I do this and somebody changes the oil in my car. I'm not good at that sort of stuff, so I get help. This is my best tool in the toolbox. I'm pretty good at taxes and financial stuff, and I don't get outside help for that, but that's my skill and my talent. But when I need help in an area, I'm very happy to call a brother or sister in Christ and say, hey, can you help me with even property and casualty insurance. I work with a very nice lady who introduced me to somebody out here in Arizona, so I have insurance in both places. I can't do property and casualty. I'm not licensed for it, so I need good help in that area. I need help installing windows or floors. Don't be afraid to get help if financial investing or taxes is not your forte. Get somebody who can help you. And I've talked to some people here that are very good at it. So maybe they don't need help in that area, and that's fine as well. So let's look at income taxes, okay? I've got about 20 minutes left here. I made a little bit of a mistake. One's a 2021 tax return, and one's a 2020 Schedule A, but it'll give you the information you need, okay? First thing I want you to do on the 2021 tax return is look at line 1. It's blank, but you can circle that, and you can say plus 32,000 there. You can write that down there. And the reason I say add 32,000 there is check your tax return. If you have more than 32,000 on line 1, and then circle Social Security line 6A. You see 6A, Social Security benefits? If you have more than 32,000 on line 1, your Social Security will then be taxed at about 50%. Do you realize does everybody know what Social Security is, right? It's the best pyramid scheme ever designed. The people who got in at the very bottom, or the very beginning of it, paid very little into it. There were 40 people supporting them that had to pay for their Social Security benefits because they didn't use their own benefits. They're using the next people to do that. And then they give you a fraction of your money back, and they tax you on it again. This is the most egregious part. They tax you on your Social Security again if you make more than $32,000. So people who love to take Social Security early because it's going to run out, they've been saying it's going to run out for 40 years. They have many, many ways to protect Social Security from running out. One thing is they tax it again. It's a tax on a tax. You pay the tax, give it to the government for 40 years, 6% of your pay. Your employer matches it. Like I said, they give you a fraction of it back, and then they tax you on it again if you make more than $32,000. So if you're at that stage where you're thinking of taking Social Security because it's going to run out, talk to somebody, talk to a professional, do some recalculation, and say, do I want to pay tax on my Social Security just to get it early at age 62? So I want you to look at 6B on your own tax returns, and if you're paying tax on your Social Security, talk to a professional. There are ways to reduce that. Yes, sir. When your income outside of Social Security is less than the standard deduction, $14,050 for single people, or $28,000 now for 65-year-olds, married couples, about $28,000. It changes every year. Sometimes it changes by $50. Sometimes it changes by $200. So I don't know the exact amount, but you've seen one of these things. It's a great Google machine. Just ask it, and it'll tell you. You know, when do I have to file a tax return? I think I looked this up last year, and it was 28 something. Yep. Very few of my clients do that, but you're right. If you only take Social Security in and you have no earnings and you have no investments, you don't even need to file a tax return. Save that preparation fee. Okay, does everybody understand where to look to see if your Social Security is being taxed again? 6B. See where it says Social Security amount on 6A, and then it says taxable amount? Some people may not even realize that they're paying tax on their Social Security. I think it's egregious. Now, how am I going to help you avoid that? Skip back up to line 4A, and this is where I'm going to help, especially your church, with the capital campaign. See 4A, IRA distributions? And then you see 4B, is what is the tax on that? Do you realize you have to take a required minimum distribution when you're age 72? Have to take it out of your IRA because you didn't pay tax on it for a long time. But if you take that money out and give it to the church, you pay tax on it. That's on line 4B. If you send the money directly to the church without receiving it first and have the check made out to Berean Baptist, you don't have to pay tax on it, yet it satisfies your RMD. I don't make up these loopholes and rules. I just follow them, and I have my Christian friends pay as little to the IRS legally, morally, and ethically every year. And I just get a real joy out of that. So I had a lady do this. She was giving $20,000 to her church. I said, why are you giving $20,000 out of your checking account? I want to be a generous giver. I said, why don't you give it out of your IRA? Because she's in a 15% tax bracket. What's 15% of 20 grand? Anybody? $3 grand. She saved $3,000 by giving it directly to the church. Anybody in this church can do that. If you're giving 5 or 10 or 15 or 20,000 to the church, you ought to be giving it out of your IRA. If you're over 70 and a half. 72 is the required minimum distribution now, but the IRS allowed you to do it at age 70 and a half. So this is something specific for retired people at 70 and a half. I told you about 20% of what I talk about will be specifically for retirees. Does that make a good strategy? So I want you to circle 4B as well and 4A. And then some of this is related to standard deduction on line 12A. Under the Tax Cut and Jobs Act in 2018, everybody complained that I'm no longer able to deduct my high state taxes. And I thought, what fools? The media just played right into this, right? Orange man bad, everybody else good, right? So when the orange man said that he's doing the Tax Cut and the Jobs Act, he actually raised, well, he didn't, but in conjunction with everybody else, but he's the administrator of it. He raised the standard deduction from around $12,000 to around $24,000 for married couples. And now it's up to around $28,000 because they give you an extra $1,000 or $1,500 if you're over age 65. So let's use $28,000 on the Schedule A now. I'll relate this to line 12B because the Schedule A gets carried to line 12A or 12B. You see that? On the Schedule A, if your gifts to charity, you can circle this on line 11 on Schedule A. If you're giving $5,000 or $10,000, you may not be able to have enough on a Schedule A if you're a married couple. But there are ways you can give money to this church, even, or other charities, without having to have it hit the Schedule A, and you can avoid the capital gains tax, for example, and ways to give out of your investments. So you need to know what you're giving away. So if you're giving $5,000 or $10,000 away, that can move the needle, so to speak. I can't do it for $300 and $400 a year contribution. It doesn't move the needle enough to make it worthwhile. But if you're giving away $5,000 or $10,000 a year, and if you're making 50 grand a year, 10%, that's a tithe. I'm not here to talk about tithing in the Levitical law, but because we're not subject to it. We're Christians. We want to give generously, we're called to do. But if you're already being a generous giver, a real tax-effective way to give is on line 12. See the gifts to charity? It says other than cash or check. If you don't have anything on that line, but you have investments outside your retirement money, that's a great way to give to the church as well. I do manage the brokerage account for the church here, but you don't have to work with me to donate to it. As long as you don't cash your stock in first, you can give to the church. We can transfer that stock from your brokerage account to the church's brokerage account. You don't pay capital gains tax on it. You may be in a 15% capital gains bracket. You may be in a 20%. You may be in a 0, but it'd be nice to know. If you gave away $10,000 and half of it was capital gains, I use the example of a client who bought $50 a week of ExxonMobil stock in the 70s for 40 years. He doesn't even know his basis, so he can't sell it. They want to know when you sell your stock, what's your basis in it. He had no idea. I said, let's start giving that away. So we start giving that away, and all of it is written off as a charitable gift, and all of it is ExxonMobil stock. Now, you can also give things here in other than cash or check. That's maybe your bundle of clothes to your Goodwill store, or furniture, or paintings. You have to prove the value. It's very easy on any specific day to tell you what the ExxonMobil stock is worth. It's traded every day. It's very liquid. It's really hard to prove what your bag of loose clothes is worth. The government doesn't fuss with that too much because nobody gives tens of thousands of dollars of clothes away. But people do give tens of thousands of dollars worth of stock away. So I just want you to know, before you cash in stock to give it away to the church, just give it to the church directly. You save the capital gains tax. Does that make sense? Okay, so I want you to circle line 12A and see if it's a standard deduction or an itemized deduction.
Is there a way to do that with real estate capital gains?
Well, you can donate real estate to the church, then they have to put their name on it, and then you'll need a realtor to do that. I'm not licensed for real estate. But yes, you can do the same thing. People leave property to the church all the time.
No, I'm asking if I sold a piece of property, instead of paying capital gains, I want to give that.
As soon as you sell it and you're the owner of that property, you pay the capital gains on it. It's a good question. If you want to give the church a townhouse for $190,000 and pay no capital gains on it, you can. You may have a mortgage on it too. So, yeah, you have to transfer ownership to the church. So the church has to own the property. Pastor would have to agree to that, or your financial committee would have to agree to it. Most churches would lovingly and willingly accept real estate.
The church sells it, do they pay capital?
No, because they're tax exempt. They're a tax exempt organization. But you have to transfer ownership from your name to the church. Same as stock, same as paintings. Somebody has to own that painting before you sell it. Yeah.
Can you transfer the part of ownership that's the capital gains part?
Yeah, that's hard to parse it out. Real estate, can you lob off the living room and sell that separately? You really can't. But I could, if I own 10,000 shares of ExxonMobil, I can give them 1,000. It's very easy to do with liquid securities. It's not as easy to do with real estate. So that's why if I have somebody who has 10 or 15 properties, they can give one of the properties to the church in a capital campaign for sure. I would suggest that if you have that much property and you have gains you want to avoid. Great question though. I'm not a realtor, but I understand owning I own 2 pieces of real estate now. I may own a third. I don't know. But I understand it appreciates in value. I bought mine 6 months ago for $190. I've got offers for $250 on it. A little 3-bedroom townhouse. So, you know, I don't want to sell it. I need a place to sleep unless I sleep here. But so, yeah. So I understand there's appreciated value in that, and I may give that away to the church so I don't have to pay capital gains on it. It might be 20 years down the road from now. That may be my gift to my church. Good question though. Okay, so circle line 12A, standard deduction or itemized deduction. And if you're under $28,000 on, well, no, you'll either be $28,000 or you'll be more. You're allowed to choose a standard deduction if you're married and over 65. It'll be around 28. If you're under age 65 and married, it'll be around 24. If you're single, that number will be around 12 or 13,000 this year. So if you're only getting 13,000 for it and you're giving away 5 or 10,000, you ought to find a more creative way to give that money away to the church. Everybody agree? Try to avoid as much tax as you can. That's where you want to call me because it's a specific question. I'm just giving you round numbers, and I gave you blank tax returns. So you need to take it back to your own tax returns and let somebody know, hey, Mark, do you think there's a way I can save $3,000 or $5,000? Remember, somebody giving away 20 grand that's paying 15% tax, that's $3,000 you're giving to the IRS. And a note to that, finish that story, the lady said, well, I was going to give it to the IRS. What do you think I should do with it? I said, give it to your church. Why not? You either give it to the IRS or give it to your church. You might as well give it for kingdom work, right? So she tells 3 to 6 of her girlfriends, hey, talk to this guy. They're each saving $3,000 to $4,000 in taxes. The church is getting 6 little old ladies giving them $3,000 more. That's $18,000 bucks. If that's not a lot to you, then give it to your church, right? You see my point? It didn't matter to her. It didn't really matter to her at all. But it's a great way to save taxes. Totally legal. The IRS. I'm showing you the lines that they let us do this on. Okay. Okay. So the other thing you can note on your own tax return is line 16 is your tax that you pay before all your deductions and before all of your credits. And on the page before is line 15 is the taxable income. So that is your effective tax rate. People say, what bracket am I in? I'm more in tune to what your effective tax rate is because it's the next dollar is what you're going to pay that rate on. You get all these credits and deductions and so forth. So the net effect is your tax on line 16 divided by your taxable income is your tax rate, effective tax rate. If you're paying more than 10% in taxes, you should try to find somebody to see where you can find more deductions. Just a general rule. And that's true for anybody. Okay? Another place to look on your tax return to save is number 7. See where it says capital gains, Schedule D? If you're paying your own capital gains, then you could be giving those shares away. So I would say if that's anywhere more than $1,000, you should be giving that $1,000 away to your church. And we have a brokerage account to accept that. Okay? So I've given you a couple tax-effective ways to save on your taxes, tax-effective ways to give to the church. We have a brokerage account. You should be giving from your IRA. If you're over age 70 and a half, give directly from your IRA. If you no longer have an IRA, maybe you have other investments, okay? Maybe you have real estate. Couple last points here on the cash flow mistakes is going into debt, not planning ahead. I'm not a big fan of reverse mortgage. That's the last desperate source of cash if you're cash rich. I have a lot of Hawaii clients. In fact, I'm leaving for Hawaii December 30th. and they are very house rich and very retirement savings poor. In that case, if you have $1 million property that's a 3-bedroom small house and you have nothing saved, a reverse mortgage may be the only way, but there's other conditions there. You have to stay in your house, and everybody's making money on your money. So remember that a reverse mortgage, the mortgage companies are still making money, and when you die, all that has to be settled before your kids get your estate. And a lot of property there stays in the house. And then one big mistake is, and this could be good for people in their late 50s or so, don't take Social Security too early, okay? Treat it as a social insurance program. Getting back to the pyramid scheme, there used to be 40 people that paid into it, and now it's a pretty wobbly pyramid. It's more shaped like this because we've killed a million taxpayers a year. We know that's an abortion, right? So we've killed 1 million taxpayers a year that used to support Social Security. Where are those? And the families are smaller. But they found a way to widen it back out because the millennial group is larger than the baby boomer group, but they just don't earn as much money now. So it will widen back out, and we will get support. So don't take Social Security early merely because you're afraid it's going to run out. The other disadvantage of taking it early and still working is your benefits from your Social Security are reduced if you make more than $14,000 a year, $17,000 a year now. So if you're going to take it at 62 and keep working at a job at $30,000, you're going to lose half your Social Security benefits because you're still working. That's not true if you're 67. You can earn as much as you want, and Social Security benefits don't get reduced. So there's a window there, 62 to 65, don't take it. And then the other disadvantage is if you take Social Security at age 62, you get an 8% raise per year until you're age 70. 8%. Who can guarantee that? It's a government guarantee, but they're deferring your Social Security at age 70. So if you're going to work age 62 to age 70, you might as well let your Social Security grow. Last thing to taking Social Security too early is if you have a bigger earner than one spouse earns a lot more than another spouse, the surviving spouse only gets to keep the higher of the two Social Securities. So you at least want one of your Social Securities to grow into age 70. So if I take mine at age 62, I could get $2,400. If I take it at age 70, I can get $3,800. Well, my wife's Social Security is less than half of mine. She could get half of mine at full retirement age. But I don't want her $400. I want her to get my bigger amount because likely she'll live longer than I am. She's on no medications, and our wives live 7 years longer than us. I've written to my congressman about it, but there's nothing they can do. She is going to outlive me by 7 years. So I'm trying to plan for that, and I'll ask the Lord what's that design. I think women are just tougher than men. That's all it is. We get a heart attack and die. Women get a heart attack and live another 8 years, right? So, all right, so don't take Social Security too early. Bring your questions up to me. Make an appointment with Paul if you want. I'll get to it in a second. I'm just summarizing so people can go if they want to. And then I'll stay and answer personal questions if you want, and then we'll start church service at 10:30. Any other general questions, though, first? Yeah. Yeah, they made it a little squirrely. 70.5 used to be the RMD and the QCD. RMD is required minimum distribution. You have to take it out at age 70.5. And you could give it away at 70.5 as a qualified charitable distribution. And that's a great way to give to the church. Now they changed the RMD age to age 72, but they kept the QCD at 70.5. So it's good. It's advantageous for us to give it away at 70.5, and you don't even have to take it till 72. But you are allowed to give out of your IRA at age 70.5. You can't give at 68, for example. You can't give out of your IRA. Yep. But you can give out of appreciated stock. Now, when people are 65 and have a large IRA, I start doing some long-term planning as well. I'm not a big life insurance guy either, but there is an index universal life plan that I use for my higher net worth people that I make a recommendation. Let's start moving this to a life insurance policy because you don't really need the big IRA, but your spouse or your church or your kids may get a tax-free life insurance benefit when you're 85 or 90. It has to be a pretty large IRA to do that with, though. You don't want to do it at $500,000 because you need that money to live off of. But around $1 million, you can start putting money into an IRA, into an insurance policy, and that's more specific for your situation. But it's a general rule, though, too, that if you have a very large IRA, you should be looking for ways so your kids don't inherit it, because when your kids inherit your IRA, they pay tax at their rate, not your old rate. You're usually in a lower bracket when you're in your 70s than your kids are in their 50s. Okay, I'll stay up here to answer questions. I'm going to let you go, get some coffee or whatever you guys do for 15 minutes before church. But thank you, and it was a pleasure. I would say give generously, find ways to save on taxes, okay? Have a great day.
You have your sign-up sheet?
I don't know where it got to. Yeah.
Throughout the next week. His sign-up sheet is going around. Just put your name down on the list, and he'd be happy to meet with you.